You've probably seen the headlines by now. Japan dumps treasuries overnight. Bond market revolt. The end of U.S. debt dominance. Some channels are framing this as a sudden shock event, a turning point, even a coordinated attack on the dollar system. If you're feeling like the noise level jumped to 11 very quickly, you're not wrong. Today, I want to slow this down. What actually happened, what didn't happen, and why the market reaction matters more than the headline itself. No panic, no hype. Just a clean look at the data and the probabilities. If you're new here, welcome to Financial Briefing. This channel is about context, positioning, and risk management, not clickbait trades and not emotional decisions. Before we dig in, let me do something most channels don't bother with, which is check the receipts. Back in early March, when the 10-year yield was pressing toward 4.35%, I said the odds favored a near-term rejection rather than a straight-line breakout. We saw yields roll over to 4.15 within 2 weeks. That wasn't perfect timing, but the direction mattered. In April, when silver was trading just under $28, I said upside acceleration would require confirmation from real rates, not just dollar weakness. Silver stalled for 3 weeks, flushed to 26.80, then broke higher, only after real yields eased. Again, not magic, just alignment. And more recently, in May, I said that talk of foreign dumping of treasuries was premature, and that any selling would likely be gradual and tactical, not disorderly. That brings us to today, where Japan reportedly reduced treasury holdings by roughly $50 billion in a very short window. So let's talk about the actual data point, not the social media version of it. The first data point is the headline number itself. Japan's reported treasury holdings declined by approximately $50 billion in a single reporting period. To put that in context, Japan still holds roughly $1.1 trillion in U.S. treasuries, making it the largest foreign holder by a wide margin. A $50 billion reduction represents about 4.5% of their total holdings. Historically, Japan's treasury position fluctuates by $30 to $70 billion several times per year. In 2022, there were 2 separate quarters where Japan reduced holdings by more than $60 billion, and the treasury market absorbed it without incident. What this means is that the move is notable, but not unprecedented. It suggests active balance sheet management, likely tied to domestic considerations in Japan, particularly currency defense and funding costs. What it does not mean is that Japan is dumping treasuries in a geopolitical statement or abandoning the dollar system. If that were the case, we would see sustained selling over multiple months, not a single reported adjustment. The second data point is the Japanese yen itself. The yen has been trading near 155 to the dollar, historically weak territory. Each time the yen weakens this much, Japanese institutions face a choice: hedge currency exposure, intervene directly, or liquidate foreign assets to raise dollars. In past episodes, 1998, 2015, and 2022, Japan responded to yen weakness with some combination of treasury sales and FX intervention. The pattern is consistent. When the yen weakens too far, Japanese authorities and institutions prioritize currency stability over portfolio optimization. What this means is that treasury selling may be more about supporting the yen than about the treasuries themselves. What it doesn't mean is that U.S. debt suddenly became unattractive on a credit basis. Japan isn't questioning repayment. They're managing currency pressure. The third data point is the reaction, or lack of reaction, in the bond market. After the report, the 10-year yield moved higher by about 6 basis points, briefly touching 4.48% before stabilizing. There was no liquidity vacuum, no failed auction, no disorderly price action. In prior true stress events, like March 2020 or September 2019, yields spiked violently, bid-ask spreads widened, and the Fed had to intervene. None of that happened here. What this means is that the Treasury market absorbed the selling without structural stress. What it doesn't mean is that yields can't go higher from here. It simply means this specific event didn't break anything. Now let's talk about the bullish interpretation, because there is one, and it deserves to be addressed calmly. One bullish argument is that foreign selling, even if gradual, adds upward pressure on yields at a time when U.S. fiscal issuance is already heavy. Treasury supply is running near $2 trillion annually. Marginal selling matters more in a saturated market. Another bullish point is that rising yields, driven by foreign selling rather than domestic growth, tend to tighten financial conditions. That historically supports gold and eventually silver as real assets once yields peak. A third point is psychological. Headlines about foreign selling can erode confidence even if the fundamentals are stable. Markets don't move on spreadsheets alone. Perception can accelerate trends. And finally, Japan is often the canary. If Japanese institutions are forced to sell treasuries to defend the yen, it raises questions about other highly indebted nations facing currency pressure. Taken together, the bullish scenario is that this marks the early stage of a broader, slow-motion shift away from treasuries, pushing yields higher, pressuring the dollar and eventually benefiting precious metals. I assign that scenario about a 25% probability. Possible, but not dominant. Now the bear case, which is equally important. First, $50 billion is small in a $26 trillion Treasury market. Daily Treasury trading volume often exceeds $600 billion. Context matters. Second, Japan has a long history of selling Treasuries temporarily and then rebuilding positions once currency pressure eases. This looks more like a funding maneuver than a regime change. Third, higher yields actually attract buyers. Pension funds, insurance companies, and global reserve managers step in when yields approach 4.5 to 5%. There is still deep demand at the right price. Fourth, the dollar did not break down. Despite the headlines, the DXY remained firm, suggesting that capital is not fleeing U.S. assets en masse. In this scenario, the market digests the news, yields stabilize, and the narrative fades within weeks. I put that probability around 30%. Which brings us to the middle case, the one I think is most likely. In this scenario, Japan continues to tactically manage its Treasury holdings, selling intermittently when yen pressure intensifies and rebuilding exposure later. Other foreign holders do not follow in size. Yields remain volatile but range-bound, roughly between 4.2 and 4.7% on the 10-year. There is no crisis, but there is persistent stress. The bond market remains heavy and confidence remains fragile, which keeps gold supported but prevents explosive upside. Silver benefits, but with volatility. This is a grind, not a break. I assign this middle path about a 45% probability. To understand why this matters, it helps to look backward. A useful comparison is 2015. That year, China sold over $300 billion in treasuries to defend the yuan. Headlines at the time warned of a bond collapse. It didn't happen. Yields rose temporarily, then fell as global growth slowed. Gold initially struggled, then rallied in 2016 once real rates turned lower. The similarity is foreign selling tied to currency defense. The difference is inflation. In 2015, inflation was subdued. Today, inflation is sticky, which limits how far yields can fall and how aggressively central banks can respond. That difference matters. It means the system is more constrained, but not necessarily more fragile. Now let's zoom out across markets. Gold is trading around $2,350. It did not sell off on the Japan news. That tells us this wasn't interpreted as a deflationary shock. Gold holding firm suggests underlying demand for stability. Silver is around 31.50, volatile but constructive. Silver tends to lag gold initially in stress events and then outperform once monetary implications become clear. Nothing here invalidates that pattern. The dollar index remains near 105. A true treasury crisis would weaken the dollar. That hasn't happened. And the 10-year yield is elevated but orderly. No failed auctions, no bid collapse. Cross-market, the signal is tension, not rupture. Positioning adds another layer. COT data shows speculators already net short treasuries. That limits how much additional selling pressure can emerge without a new catalyst. Banks remain net long bonds, albeit lightly. That suggests they are positioned for stabilization, not collapse. In precious metals, specs are long gold, but not euphoric. Silver positioning is still moderate. That's not bubble behavior. So here's my personal action plan. And as always, this is not advice, just my framework. If yields spike above 4.75% on the 10-year without a dollar breakout, I add to gold and silver on weakness. If yields fall below 4.2 with the dollar breaking down, I add more aggressively. If yields rise and the dollar strengthens simultaneously, I reduce silver exposure and hold gold steady. Right now, my allocation is roughly 12% gold, 6% silver, 60% cash and short-term instruments, and the rest diversified across equities. My risk management is simple. On silver, I respect stop loss near 28.50 on a closing basis. On gold, I reassess below 2,200. Take profit isn't a single number. I scale out into strength, particularly if silver approaches the mid-30s without confirmation from real rates. Again, not advice, just discipline. There are also things I'm deliberately not doing. I'm not panic buying because of scary thumbnails. I'm not watching fear-driven content on loop. And I'm not assuming this is the collapse of the treasury market or the dollar system. That assumption has been wrong many times before. What I am doing is watching a few very specific things this week. First, the next treasury auction. Strong demand above 4.5% is bullish for stability. Weak demand is a warning sign. Second, the yen. If it strengthens meaningfully, treasury selling pressure likely eases. If it breaks lower, expect more noise. Third, real yields. If real yields roll over while nominal yields stay high, that's constructive for precious metals. So let me wrap this up. Japan did reduce treasury holdings by about $50 billion. The market absorbed it without breaking. And the bigger story is ongoing stress, not sudden collapse. If you value calm analysis over clickbait, consider subscribing. This is Financial Briefing, and as always, stay sharp.